Hi, this is Joe Rabil. I wanted to follow up with from a prior video. This is U.S. Steel again. Again, I've got the weekly chart on the left side and the daily on the right. If you remember from the prior video, I focused almost the entire time on looking at the higher time frame moving averages and looking for the parallel nature that's going to provide a pretty good backdrop. Whether you're in an uptrend or downtrend, you want to see these lines looking semi-parallel to show when you're in a strong trend. And that's, again, if you're looking at that and you don't want to, if you're not looking at indicators, or you're not using the indicators as a screening tool. But let's go back. I want to refine the entry. Because if you notice, when I talked about this, I waited for the lower time frame to have the same look to it, meaning the 40. So I was talking about when the 40 was declining and the 18 was declining and the entry is way down here. So what I wanted to explain is how I would use the MACD to help really trigger me into the higher time frame with a much better entry point. And I think it can provide this advantage as long as you see, you've got to have a few criteria in place. I mean, I don't think you can use it every time. And as I mentioned in the past, in other videos, you can't expect the lower time frame entry point to be the same every time. If you sit there and say, I'm going to take the break of the 40, the risk reward on those trades sometimes are just not very good, or there's going to be times where you're going to have to wait for an inordinate period for it to rally up against you and then come back down. You really have to take it in the context. You have to be looking at price action. You have to look at the price structure. You have to look at the moving average structure. And then you also have to look at the momentum of the move. So if the trend is down on the higher time frame and I'm looking at the counter move on the daily here, I really want to see some signs that the momentum is slowing. And if you look at I've got a standard MACD down here. Some people might use Linda Raschke's 310 oscillator, and that gives a little bit more of a glaring look based on the MACD lines themselves. What I like to do is, if I'm looking at MACD, I have the histogram up here. The histogram is simply the difference between this MACD line and its moving average. So if the blue line is separating and moving up at a faster rate than the red line, then we get a pretty big mountain on this histogram. And if they start to tighten up, or the blue line starts to lose a little momentum relative to the red line, then we start to see it drop off. So one of the things I like to see is if this is moving up and we've got the 18 above the 40 and both lines are rising, I want to see this histogram starting to show lower peaks. So even if the MACD hasn't broken and is making a clear bearish momentum divergence sign, I kind of want to see at least some signal that the histogram is losing some strength. If I see that, I'm probably going to be a little bit more on the aggressive side. If we've made a big run and the 18 is pretty far away from the 40, I might not want to wait for the 40 to break, or I might not want to wait for these to come in line, because you got to realize what I'm trying to do. I'm trying to get an entry from the lower time frame. I'm trying to get back into the higher time frame trend. I know the trend is down on this time frame. I know I've gotten a rally of 6 or 7 weeks. I now want to look to try and re-enter this to the downside. And so I'm going to go to this time frame and I'm daily chart and try and get a better entry. I'd prefer not to get a later entry. I'd rather get an earlier one. Sometimes you don't have that option, and there's nothing wrong for waiting for a match, meaning I've got an 18 and a 40 both declining, and they're matching the trend of this time frame. There's nothing wrong with that. You can definitely do that, and I think it will increase your odds of success. But in terms of profitability, I think if you watch, let me just show. I'm going to put the line here where this big bar right here coming down through the 18, violently coming down through the 18, certainly counteracting all this move to the upside, because you're taking out this one bar is taking out probably 10 or 15 days worth of price action. And if I see that and it's a cross, meaning the MACD is crossing down through its signal line on the same day, I'm going to be, I really would consider doing this, as this is breaking the 18 and I know the MACD is kind of getting back in line. This gives me, if I know I've got MACD, I should say histogram divergence in place, and then I get a MACD crossover, and it's happening as the price is also crossing down through the 18, I think I'm willing to be a little bit more aggressive in this scenario and not have to wait for this whole process of going through and getting in somewhere down in here, over here. I think I can really improve my risk reward ratio by doing this break of the 18. And again, the idea here is to try and identify the earliest point where I'm looking for what we call an opposing trend trigger. I want to get in. This trend is opposing this trend, which is down. This one's up. I'm looking for the first sign that this trend is going back down and getting back in line with this trend. And so if I can use MACD to help improve my odds here, I'm going to use it. And especially on these big elephant type, a violent type down bar, it's really easy to see in the format of a candlestick, where you get, all red sellers from the get-go, start the day, finish off to the low on the low end. You don't know that if you're getting it at the cross of the 18, but you have a lot of confirmation by day's end. But I just wanted to point out on this video, because I've shown another video where I'm looking at, say, like a divergence using the 310 oscillator. I tend to stick with what I'm good at, and I know the MACD very, very well. And I think it can provide really helpful signals. I'm going to use other examples in new videos to show how this can be a really confirming and nice trigger point in a lot of different ways. So let's just take another quick look. I want to pull up the Alcoa chart. And again, looking at this period here, I used this in a prior video as well when I was showing the technique of going in the zone and out of the zone. But again, the cross of the signal line to the downside gives really nice confirmation that this is your trigger point, that the trend is starting to go back down in line with the weekly trend. So in this case, it was a break of the 40 that was actually giving you the signal. It wasn't the break of the 18. So this is why I like to incorporate the MACD into my trigger mechanism for the lower time frame. There's a lot of detail on the lower time frame. And again, as I've said in the past, it's not going to be the same each time. You have to see the strength of the rally, counter rally, and know where you are in relation to the price structure. And I think if you do these types of things and you can incorporate MACD, I think it's going to really help with your timing.